Hello and welcome to the DIY Investing YouTube channel. Today we are working through every company in the S&P 500, and today is BlackRock Incorporated, ticker BLK. Business is in the capital markets industry, and over the next few minutes I'll discuss both the valuation of this company and my thoughts on its business quality. First thing up, we can see that the market cap and enterprise value are basically the same. So this company isn't carrying a lot of net debt or net cash. So BlackRock is a publicly owned investment manager. You may know BlackRock as one of the largest investment managers in the United States and the world, similar to a Vanguard, except it's publicly owned. They provide services to institutional, intermediate, and individual investors, including pension funds, insurance companies, mutual funds, endowments, etc. They are a huge asset manager. They have equity, fixed income, balanced, and real estate mutual funds. So first up, let's look at return on invested capital. You can see every year for the last 20 years, they have been profitable, and that's a very strong sign. We like profitable companies. We like companies that never have any losses. That suggests it's fairly high quality. Now, when you look at this as well, you can see that they kind of bottomed on return on invested capital in 2006, and every year since 2009, they have steadily increased their return on invested capital to the current double-digit 11-12% range. Now, I like the steadily increasing returns on invested capital. It means that you have positive trends in this business. It's also very stable from year to year. Although it's increasing, it's not fluctuating a lot. It means it's not super cyclical, and that's a very good sign for the quality of the business as well. So very positive signs of business quality from what we can see there. 10-year median returns, return on invested capital of 10%, return on equity of 12%. This is a little low. I like that we're in the double-digit range for return on invested capital, but I really like that return on equity number to be in the 15% plus range, so we're on the little bit of a low side, but overall, very high-quality business from what we can see so far. Price to earnings ratio of 14%. This seems like a very reasonable number. You have strong returns. You have positive returns on invested capital, positive returns on return on equity, and you're under 15. I like buying companies at a PE of under 15. It means I'm buying a value company. Your average company is worth about a PE of 15. So if you're buying a below average price, but an above average company, that sets you up very well for positive returns. The other thing I like to see here is that your revenue has been growing at 7.9%, but your assets have been dropping. This means that they have strong operating leverage, which is why the return on invested capital is getting better over time. They're growing revenue without growing your assets. Very, very good for shareholders. It's why they've been able to turn that 8% revenue growth into a 12% earnings per share growth. And once you start getting to that 12% earnings per share growth range, you're talking about very strong returns for shareholders over the course of a decade. And so we can probably see that when we go to earnings per share. Started at $13 in earnings per share at the beginning of the decade to $8. So you basically tripled your earnings per share in a decade. Very strong returns for shareholders with those types of numbers. So I'm liking everything what I see here so far. Good valuation, good business quality. We're going to continue to look at the balance sheet and income statement next. If you're enjoying the video, please hit the like button and subscribe so you can get more great investing content each and every week with notifications. So let's go to the income statement. Income statement, we're going to see continuing positive trends here. You see that there's a lot of revenue compared to your cost of goods sold, very strong margins in this business. And so as they continue to grow, you're still growing your gross profits, basically doubled over the course of the decade. Now, they've not had to double their SG&A. They've not had to double their operating expenses, which has allowed them to continue to get improving margins from that as well. Now, we can look at the shares outstanding. They've also had declining shares outstanding. This suggests they're buying back shares regularly, as each and every year the shares outstanding has gone down. Very positive sign for good capital allocation. I like what I see there. Now, PP&E, you can see they have a little extra PP&E in this time, but really they have a lot of goodwill and intangible assets. When we remove this out, now I don't know what other assets are. So that makes it a little difficult, but they've actually been able to lower their assets over time, which is where we're getting that improved return on invested capital, because they've been able to lower their assets while increasing their returns. They do have some debt, but the debt's been relatively steady. You have these other liabilities. Now, part of that, I think, if I were to dive into these other assets and other liabilities, would be looking at how they manage these funds, and those funds probably play into that asset-based number. Cash flow statement. You can see they do have stock-based compensation and fairly high, $50 million, growing to $730 million over the course of the decade. A lot of stock-based compensation. But every single year, they're buying back more shares than they issue, which is why you're seeing those shares decline over time. The first, third of this net issuance of common stock is probably basically just simply offsetting the dilution that they would have, and the remaining 2/3 is what's allowing them to lower their stock outstanding. Not only are they issuing stock, removing stock, but they're also paying dividends, and you can see that they've had positive cash flow each and every year. So that's all looking very strong, and they're not having to invest a lot of cash back into the business. They have an acquisition here and there, but for the most part, this business is producing cash, and they're using that cash to return it to shareholders. So I like everything I see here. I think BlackRock is a really interesting company. They're having returns on invested capital that are improving over time. They have operating leverage. They're growing their revenue without growing their assets. They're actually lowering their assets over time. And that double whammy is allowing you to have double-digit earnings per share growth despite only having 8% revenue growth. Good valuation of 14.6. I don't need it any lower. It seems like a very reasonable valuation here. So for me, BlackRock's going to go on my watch list. I like it. Looks very attractive at these prices. And so if you like this video and you want more investing content like this, please hit that like button, hit the subscribe button as well, so that you can get notifications as I upload new videos each and every week going over more and more stocks and investments. Thank you for listening. And until next time, stop paying fees, start building wealth.